Hello everyone, my name is Pemoncho, and in this presentation our group will take you all through the concept of yield curve inversion and its impact on public sector banks and the state-owned enterprises in context of India. I'll start by outlining what a yield curve represents before moving with the causes and impact. Let me begin with basic. What is a yield curve? A yield curve shows how interest rate changes across different maturities of debt securities. Under normal conditions, it slopes upward because the long-term bond usually offer higher yields than the short-term one. But sometimes the curve flip, which is called a yield curve inversion, when it inverts. When it inverts, the long-term bond offer lower interest rate while the short-term bond offers higher interest rate. This kind of shift often signals uncertainty in the market. Now let us look into a recent event which occurred in Indian bond market that caused the inversion. The immediate trigger was an auction of 365-day treasury bills by the RBI on March 8, 2023. The cut-off yield rose to about 7.48%, slightly above the 10-year government bond yield at that time. This happened because the banking system was facing a liquidity deficit and inflation risk was still present. With tighter conditions, investors demanded higher return for short-term debt, which pushed the 1-year yield above the 10-year yield and caused the temporary inversion.
Now I will explain the key determinants behind an inverted yield curve in India. First, tight domestic liquidity. The Reserve Bank of India actively withdraws excess money from the banking system to fight inflation. This creates a cash shortage, forcing banks to pay higher interest for short-term funds. This directly pushes up short-term bond yields. Second, persistent inflation fears. When market believe high inflation will force the central bank to keep policy rates high for a long time, those expectations gets priced into short-term bond yields, keeping them elevated. However, if there is confidence that this action will control inflation in the long run, long-term yields don't rise as much, causing the curve to invert. And third, monetary policy actions. Sometimes a rate cut by the RBI to stimulate the economy can backfire. If it sparks fear of lower future growth and inflation, investors rush to lock in long-term bond yields before they fall. This high demand drives long-term yields down while short-term rates remain relatively higher, leading to an inversion.
The impact of yield curve inversion to the public sector bank and state-owned enterprises. Number one, severe net interest margin compression. A yield curve inversion disastrously squeezes bank profitability by pegging the cost of funds to high short-term rates while limiting income from new long-term loans to low long-term rates, effectively killing the bank's core profit engine of borrowing short-term and lending long. Number two, public sector bank credit rationing. A public sector bank seeking to protect its capital and finances will rationally become highly risk-averse due to negative profitability of new loans, leading to credit rationing that drastically reduces new long-term lending, with small medium enterprises and new infrastructure projects usually becoming the first victims. Number three, a shift to lazy banking. Public sector bank invests deposits in safe short-term government T-bills instead of riskier loss-making loans. It's a rational move to secure the bank's balance sheet, but is detrimental to the economy because it diverts funds away from new businesses, jobs, and investments.
Now, the fourth impact, inherent policy conflict for public sector banks. Public sector banks face a major conflict during a yield curve inversion. Their commercial responsibility pushes them to cut lending to avoid losses and protect stability, but their government mandates require them to continue lending to priority sectors like agriculture, infrastructure, and manufacturing. This clash often results in policy paralysis, slowing the overall credit supply in the economy. Fifth, capital expenditure deferral by the SOEs. State-owned enterprises rely heavily on public sector banks to finance large infrastructure and industrial projects. When public sector banks pull back on the long-term lending, state-owned enterprises face a credit shortage, making it difficult to fund plant investment. As a result, big capital expenditure projects are postponed or cancelled, which slows construction, manufacturing activity, and job creation, creating a broader economic slowdown.